Hi, welcome to this month's video from Flying Colours. Those of you who've been watching them for a while know that I tend to focus on the outlook for the global economy, what that means for investments, what we've been doing in the portfolio. And naturally, because equities tend to be more volatile than bonds, I probably spent more time talking about them than I have other assets that we hold. But within the portfolios, more than half of our assets are actually in bonds. Our clients overwhelmingly are either approaching retirement or just entered retirement, and they tend to have a slightly lower attitude to risk than younger people. So of course, they'll tend to have more bonds than they might have done when they were 25 or 30 years old. The return from the bond side of our portfolio is therefore very important. Now, what I want to focus on today is why we feel so positive about bonds from here and what we think the outlook is and what it's going to mean for portfolios. To understand what's going to happen to bond returns in a portfolio, you've got to break it down into the two areas that make or lose you money. The first one is, what interest are you going to receive? What is the yield? And that's obvious. And the second one is, what's going to happen to the required yield for new investors in those bonds in the future? If yields go up, the bond price will go down, and if yields go down, the bond price will go up. So if you have good yields and falling yields in the future, you'll both make a high level of interest and you'll make money from the bond itself. And that is exactly what I think is going to happen. So in our portfolio today, yields are up to around 6%, and that is double what it was a year ago. And these are sustainable long-term yields that we can expect as investors. Now, inflation today might be 10%, but the market expects it to fall down to 2 to 3% within a year or two. So very shortly, we're going to be making an attractive inflation-adjusted yield just from holding on to the bonds we have today. And that is a real positive and something that we haven't seen for a while. The second thing is where are yield expectations going to go? And for this, it's helpful to look back over about 40 years. So 40 years ago, interest rates went as high as 15%. So you might think that interest rates will go that high again, but actually I think it's very unlikely, because at the time interest rates were 15%, total debt in the economy was less than a third of what it is today. So if you think about how interest rate rises work, they cool the economy down by sucking money out through higher interest payments. Well, if debt is 3 times higher, the amount of interest that you need to charge the economy to cool it down should be about a third of what it was before. So 15% in 1980 is broadly equivalent to 5% today. And that's where yield expectations already are. So actually, I think it's useful to think of it in that framework. And on that basis, we expect over the next few years, yield expectations will reduce and the bond prices will increase. So from here, as a bond investor, you'll both get an attractive yield and you should get capital appreciation. So more than half of our assets are in bonds, and I think this is a really great backdrop for the portfolios and in particular bond investors. Within the portfolio, we've been using this understanding to make quite a few changes. So inside the bond portfolios, we've actually added risk in the last few months. So for the first time ever, we've bought high yield bonds, and we've increased our UK corporate bond exposure. And both of those things are something that we think is going to add quite a lot of return over the next 12 to 24 months. And overall in the portfolios, we've actually been reducing equities and increasing bonds. Now, so what our strategy is to try and make sure we protect capital during times of weakness, which is what we think is going to happen in the equity market, and to make sure we take advantage of opportunities when they come up, which is what's happening in the bond portfolio. Overall, I would just say to people that I think we're very much on track within the portfolios, and they're kind of doing what we'd want them to do. And I feel that the positioning that we have is going to protect people, and we will be able to make attractive returns over the next few years. If you have any questions about this, I'll be delighted to talk to you individually. Please get in contact. If you haven't yet subscribed to our YouTube channel, just click on this icon and you'll automatically get the videos. And lastly, as always, I must remind you, I've been talking about investments and your capital is at risk. Thank you.